Ask a bond fund manager, and the first thing he'll tell you is to keep it short. Here to talk about why is Chad Stevens from RidgeWorth. Welcome, Chad.
Thank you.
Tell me why bond fund managers are so obsessed with the short end of the yield curve.
The short end of the yield curve offers much less volatility in today's environment. With interest rates being so low, the carry is just not that great as it was a couple of years ago to be able to offset declines in principal value.
Let's talk a little bit about the yield curve. A lot of bond fund managers, save Jeff Gundlach, think that yields are not going to get back below where they are right now. He thinks they're going to get back below 2%. Right now, the 10-year Treasury is, say, let's call it 2.6%. Where do you think it's going to be at the end of the year?
I think we're probably trying to develop a new trading range with the next hurdle being getting through 240. I think 240 is going to be a tough area to get through, and that may prove to be the lower end throughout the rest of the year.
And when it comes to government securities, you run a ultra-short government bond fund. Do you prefer treasuries or agencies right now?
Right now, we still prefer mortgage-backed securities. We think on the shorter end, the extra yield still makes the break even versus decline in value very attractive.
And when we talk about agencies, we're talking about Fannie Mae's and Freddie Mac's, of course. So
Exactly.
tell me, with regard to these, are the discussions now about the future of Fannie Mae and Freddie Mac, are they going to have an impact on these securities?
I don't think they're going to have an impact on the existing securities. More than likely, we may have a new class of securities going forward. In fact, there's a new deal being talked about in the market now, a risk-sharing deal that they call it, that may be the new model going forward.
And because there's such demand at the front end of the yield curve for agency bonds, are you seeing the prices move down a little bit?
We're seeing spreads compress a little bit throughout the year, although they've gone out a little bit in the recent sell-off, but the trend has been to tighter spreads throughout the year because more people are moving into the space.
And is that advice for investors to keep it short also apply to corporate bonds and muni bonds and any other type of bond funds out there?
Yes, I think so, but it's also important that cash go to a cash vehicle. Where, as I said, the income is not that great right now, so the likelihood of any short-term period producing negative returns is greater than it's ever been. So cash needs to go to money market, and these funds, such as the RidgeWorth U.S. Government Securities UltraShort Fund, should be looked at over the 6-month to 1-year time frame.
All right, thanks a lot, Chad.
Thank you.
Thank you for watching The Street.